David Rosenberg, the chief economist at Merrill Lynch, reminds us that not long ago it was the economy that drove asset prices, such as stocks and bonds. Today it is the reverse, with asset prices driving the economy. There was a time when the Fed cut short-term rates to low levels for a brief period when it wanted to stimulate the economy or the investor. Those rates have been almost zero for 4 years now. The Fed is therefore completely altering the relationship between stocks and bonds by nurturing an environment of low interest rates, not even coming close to offsetting inflation. Most maturities of government bonds yield 1% or less, and inflation is over 2%. However, profits on the S&P index are quite strong. This is an anomaly none of us expected. There is no question the Federal Reserve can influence asset prices, and it will continue this intervention until unemployment gets much lower. Investors, however, remain cautious. But for me, the answer is common stocks with a focus on dividend yield and dividend growth and a strong balance sheet. History suggests only 2 or 3 more years of flat markets lie ahead. I say that based on a chart of the Dow Jones average since 1900. And that chart suggests that we've had 4 periods of flat markets during that 112-year period, averaging about 15 years, followed by bull markets in each case. This current flat period started in 1999, 13 years ago, when the stock market first reached its current level. With respect to bonds, it is a nightmare for the saver today, but a joy to those who need to borrow money. Money market yields are practically nothing, and you have to go out to a 10-year maturity on a treasury to get a 1.7% yield. And normally one expects to get about 4% at that level. I want to digress for a moment and to mention defense spending. Military spending is on the wane. In early November, George Friedman of Stratfor Research, and I recommend his website, I think it's $30 a month, he wrote an interesting memo on foreign policy. He said, we have emerged as the only global power in 1991 when the Soviet Union fell. We remain so despite costly wars in Iraq and Afghanistan. Disintegration in Europe and financial crisis in China means we remain the unchallenged global power. But constant use of military power is not an option. Our mistake was inserting insufficient force to defeat an enemy that could be managed by other means and whose ability to harm us was limited. The last gasp in that philosophy was Libya, out of control even before Benghazi, thus insufficient force against an uncertain enemy of little importance. We cannot continue to be the global cop. We must pursue our own interests at the lowest possible cost, even though we're 25% of the global GDP. We should have a ruthless indifference to things that don't matter that much to us. If it does matter, then we should go all out. Back on the market, my advice is do not panic over transitory news. I've said this before. In fact, I'm quoting from what I said about a year or 2 ago. Stick to your plan. Many investors succumb to emotions, sell low and buy high. Year in and year out, 3/4 of all mutual fund investors fail to match the benchmark that they were invested in for that reason. One, therefore, should prevent emotion from overtaking reasons. In fact, there is a course at MIT on behavior economics that goes into that. The point being that market timing seldom works. Look at those that were not fully invested the day before yesterday or last Friday. Yours truly is among them. Remember, it was Disraeli who once said, what we anticipate seldom occurs, and what we least expect generally happens. The stock market in the last 5 years has absorbed the shock of $500 billion of net redemption of stock mutual funds, in contrast to over $1 trillion pouring into bond funds. Over the last 5 years, stock funds returned 1.2%, while bond funds returned 6%. In the past 12 months, however, stock funds, as Bob reported, were over 15%, while bond funds returned less than half that. According to The Economist, the average hedge fund returned only 3% over the past year. The S&P, therefore, has outperformed the average hedge fund for 10 straight years, with the exception of 2008. Well, how did my forecast last year pan out? I was wrong on 4 of 9 forecasts: oil, unemployment, the euro, and the S&P. I was close in 2012 on my real GDP forecast of 2%. It was actually, as near as we can tell, 2.2. Our economic growth will not return to the pre-crisis rate of 3% this year, because dancing on the fiscal cliff and weak export demand will hold us down to about a 2% rate. Another disappointing year of recovery, the 4th disappointing year in a row. However, relative to Europe, we will continue to be the bright spot. I had earnings forecast on the S&P up 5% this year. It's up 7%. I look only for about a 2% gain this year because of a profit margin squeeze. I expect inflation to be benign around 2%. I'm staying with that forecast for this year. No change in interest rates, with my forecast on the 10-year Treasury staying at around 1.9. I look for rates to rise slightly beyond that. I thought gold prices would rise 10%. It only rose about 6% to $1,660. I'm guessing it'll be over $1,700 this year. I had the direction right, but was too timid on stocks. It was up 13%, well, 15% including dividend. My forecast was only for a 5% rise. I do look for at least a 5% gain this year. After all, we've had 3% in the first day. I mean, this is unbelievable. Well, 2%, right? The European currency stayed at $1.32 on the dollar. I thought it was going to weaken to about $1.24, so that was wrong. I don't look for any change this year. I was also wrong on oil, where I thought the price would rise to $110 a barrel, and instead it fell to $89, a 10% drop. I expect, though, it will rise a little bit this year to about $95. I was also wrong on the size of the drop in unemployment. I thought it would only drop a little bit to about 8.6 to 8.3. Instead, it fell to 7.7. It will probably drop maybe to 7.5 this year. I still like to have a global portfolio with an emphasis on dividend yield. There's nothing like a portfolio with a good yield to quiet the nerves in a fragile economy. I prefer stocks with a global, not just domestic focus, emphasizing taking advantage of growth opportunities in emerging countries. Thus, 3 of my 6 stock picks are foreign, and the overall yield on the 6 stocks is just under 5% at 4.9, including 3 holdovers I just can't walk away from last year. My first pick is Shaw Communication. Ticker symbol is SGR, a Canadian cable company, satellite TV operator, a steady 7% earnings growth, 13 times earnings, yielding 4.5%. We like the outlook for our neighbors from the north, not just their economy, but this particular stock. One of my carryovers is Philip Morris International, which is 100% in foreign cigarette stocks. I like the 4% yield and the steady earnings growth. I also believe that earnings will continue to grow, at least on a per share basis, at about a 10% rate. Another carryover from last year is Microsoft, selling at 27. 3.5% dividend yield and a 10% growth on a stock that's AAA rated, probably a stronger rating than we have on government bonds. And probably one of the most underappreciated stocks on my list. Last year, they introduced Windows 8, its new operating system, and received very favorable reviews. It also partnered with Nokia in introducing Windows for the smartphone market, and also it introduced its first computer, the Surface tablet, to compete against Apple. Both products have been well received in these two huge markets, yet Microsoft stock today, which used to be the biggest company in the public markets, is only a fraction of the market value of Apple. Pfizer, this leading drug stock, is 11 times earnings. Ticker symbol is PFE, and it has a 3.5% yield for what is the dominant drug stock. Foreign earnings are 60% of the total, and I like that fact. It's recovering nicely from the patent cliff with a pipeline of new products in various stages of introduction. Here's a spicy name for you never heard of. It's a Norwegian company called Seadrill, ticker symbol SDRL, around $36 a share. This Norwegian company provides contract drilling internationally through a modern fleet of offshore drilling units. Its chief appeal is its 9.4% yield. If it doesn't work for you, talk to my partners that are sitting right there and this one right here. But McDonald's is another carryover stock. Yes, it declined last year 13%, reflecting a disappointing 1% gain in earnings. But the dividend just increased 10%, giving a 3.5% dividend yield. I believe the current slowdown in earnings is temporary. Foreign earnings are 60% of the total. On a final note, a quote from Charles Darwin. It's not the strongest species that survive, not the most intelligent, but the ones most responsive to change. Thank you very much.